Welcome to Real Estate 360 Live with Ryan Sloper, the trusted name in real estate radio. Now, here's Ryan Sloper.
Welcome back, everyone, to another episode of Real Estate 360 Live. I'm your host, Ryan Sloper. For those of you not familiar with our weekly podcast that we do, it's for all things real estate. So we're not just going to cover, like I said, whether home sales are up and down. We're going to give you the backdrop, what's going on with the economics behind everything, what's going on with the artificial manipulation of interest rates that actually have been suppressing mortgage interest rates for some time now, which have obviously led to, some rising home prices. Obviously, we've got pretty tight inventories in a lot of the major metropolitan areas, coupled with low interest rates. Obviously, we have some rising prices. We have some interesting statistics to cover today as far as cash transactions that took place in February, which will really, I think, shed some light on how many people are actually buying properties with loans, which you would imagine that many first-time home buyers would need loans. They wouldn't be able to pay cash. But I think it's going to really highlight what's actually taking place in the market, regardless of what the national media has us believing is taking place. I think that'll be something we'll look forward to. Also, we're going to jump into an article that was in a couple different places of home buyers that are getting priced out, new home buyers, that is, that are getting priced out of the market. And I'm going to, shed a little bit more light of some creative things that you can do to potentially set yourself up to get your contract accepted. We covered that about a month or two ago, and I want to jump back in because I know this is a major frustration that many of you have. Now, for those of you not familiar, you can always go to our iTunes or go to the iTunes store and search in the bar Real Estate 360, and you can subscribe to our podcast there, as well as stream it, pretty much on demand whenever you want on the website at realestate360live.com. That's realestate360live.com. Also, there's a button on the right-hand side, an Ask a Question button. That's for all of you listeners that have been, writing in with any of the questions that you have in regards to mortgages, to credit, to real estate, anything that, could affect you in your real estate decisions. We'd be glad to answer on this podcast. I mean, the show really is about helping people out and getting, your questions answered. So we'll cover, a few questions that we've had from listeners over the last few weeks later in the show. Joining me on our panel, as he does each and every week, is Louis Camarosano. Louis is a former school teacher, a former attorney, and a former general manager of a major real estate portal. He's often cited in the media as a real estate industry expert. He's been cited in the Wall Street Journal, Forbes, Smart Money, Fox Business, MSN, and numerous others. Louis, how you doing today?
Doing grand, Ryan. How are you?
I'm doing well. Thanks for asking.
Excellent.
So, we have the markets were, as far as economic data for the last couple of weeks, it's been kind of stagnant. Not much moving the market one way or the other. This week, actually, has been interesting because mortgage rates have started to tick back up a little bit. Now, obviously, we had the ADP employment private payroll report that came out. What I found really interesting was, and this was out yesterday, so it came in at 191,000 versus the estimates that ranged from 195 to 203,000. Now, everybody in the media actually read this as a strong reading. Since when have we gotten to the point where when there's an estimate that comes in lower than expectations is that now considered a strong reading?
When the expectations were low to begin with.
Exactly. The expectations were low to begin with. I can tell you when this happened, and it started to happen because the snow has now ended, as we've mentioned, Louis, right? So now it's basically like they want to show that, hey, everything is moving back in the right direction, and it's only a miss of 4,000 from the low end of the estimate, so we'll just consider that a win. Right? We'll consider that a win. So stock market rallied again. What happened? Bond market gets worse. As a result of the bond market getting worse, we had mortgage interest rates that are now rising. We now have the 10-year bond at a 2.8%, which is a support level. Those of you not familiar with support levels, once you break through or you pass through that level of resistance, which at 2.8 is the level of resistance that we're sitting at right now, once you break through that, the next ceiling is 2.9. So, things can move relatively quick, and we could literally see us lose another 0.25% of interest rates or higher interest rates Just because the market is now, it looks like everybody's rallying behind that. Okay, the snow's behind us now. It looks like job reports are going to come in great. We have today we have jobless claims that come out, I believe, at 8:30. Or that's actually, it's at 8:30. And we also have what was it? Is it ISM non-manufacturing also comes out today, right? So that's an important report because that represents about 2/3 of our economy, known as the service sector. The market is expecting a strong reading of 53.5, and any reading above 53 will likely put some more downward pressure on pricing for mortgage interest rates. So it'll be interesting to see how this kind of all pans out. I can just tell from reading all of the articles online, as I'm sure you can, Louis, that it's like everybody's getting behind this push into the spring, that everything is just peachy and that we're moving in the right direction. So want to kind of just get your take. Obviously, you've been reading a lot of the same stuff that I have and probably think it's a joke as well. But where do you see things going, obviously, with the jobless claims report on deck and obviously moving into the spring market? What are your overall thoughts?
Well, I'll give you one to start off. On Bloomberg, March 31st, home sales in U.S. poised to surge with spring.
That's a good one.
Why? What has happened? Oh, I'm sorry. It's spring. That's right. The weather impacts everything that people do, not how much money they have, not whether their wages have risen, not whether they have jobs. But when spring comes around, then the surge happens. As respect to the economy, Ryan, you and I have spoken about where interest rates are headed when the Fed stops buying, and we've puzzled and scratched our heads and tried to figure out how a rate's going to stay low if the Fed isn't buying and providing the support for the U.S. Treasury bonds. And we're seeing as the taper goes on that the rates start to creep up. Well, what is Yellen talking about now? Well, before she got appointed, you and I had discussed on the show that Janet Yellen was a big proponent of the labor market. And she wanted to make sure that things happened so that the Fed was completing its dual mandate, one of not just bailing out the banks, but also providing a stable labor environment. Many Fed presidents have said there's absolutely nothing the Fed can do to get people jobs, but no mind, that's what Janet Yellen stated she wanted to do when she was a Fed president. And just the other day, she came out with a speech, almost a political speech, where she started talking about 3 people who were having trouble in the employment market and how she was going to help them. Now, this is a farce because she can help them, but she's going to try. And as we see, she's going to use the labor market as they've eliminated the 6.5 threshold.
Right.
Or once you hit 6.5, then they can start letting rates rise. Well, they know they're going to hit 6.5, and Fed President Bullard has said they're going to blow through that. They're going to be at 6% unemployment by the end of the year. And the reason for that is not because the labor market's improving, because people are leaving the labor force, so the unemployment rate goes down. And so now the Fed has already started talking about, and Janet Yellen, they have new tools to measure the labor market, and she's puzzled why it's not doing better. And she's going to want to leave her mark on the labor market. Now, take that against the backdrop of what's happening in the economy and with rates. As rates go higher and they're tapering QE, she's not going to say, well, we can't continue the taper and we can't stop buying Treasury bonds because the rates are going up. She's going to start doing some printing because she wants to help the labor market. And, of course, when she starts printing again, then the bond rates will come back down. So we said at the beginning of the year, they're going to try to stop QE. They want to get out of the QE business. It's bad for public relations. They've got $4 trillion on their balance sheet. But also, they don't know what else to do, and their DNA is to print money. So they'll come up with some reason to help the labor market. I don't know what it is, but they cannot stop tapering. They can't continue tapering and expect that interest rates are going to stay low. And, if the rates go higher, that kills the economy. That kills at least the investor portion of the housing market. And the economy goes back into, they're tapering into a recession right now. So I asked the question again, Ryan, what are they going to do if they continue to taper, the economy doesn't improve in the spring, and rates go higher?
Well, at some point, they're going to be forced to recognize, and Yellen will probably come out and be like, well, we thought it was just the snow, but now that we have a couple of quarters of basically negative growth and we don't have the jobs that are showing up like we thought, we're going to need some sort of stimulus, right? Those are the only, bullets that they have. They have to keep using the same thing. They might just restructure it, right? They might call it something different, just so that it draws different media attention and people will be talking about it. But if you watch any of these shows, MSNBC, CNBC, all these hedge fund guys that they bring on, they're all saying the same thing. When they're asked the question, okay, well, all the Fed members are out there talking that it looks like they're going to start raising the Fed fund rate in the middle of 2015 or the end of 2015, which, by the way, guys, is next year, right?
Right.
Because
12 months.
They're saying next year. I can tell you right now with almost 100% certainty, Louis, that will not happen. That will not happen. That's
right. They were going to stop QE in 2010. They were going to stop it in 11. They were going to stop it in 12. They do stop it, then they start it back up again.
That's what I was about to say. So this is basically, they're in so deep, they don't have a way to get out. They do. They could just get out of it and let the economy take its course, which is going to be to get worse first and then start to work its way back better. But they're not going to let it happen. And I definitely don't think it's going to happen on Obama's time. I've been quoted as saying that numerous times. It's not going to happen while he's in office. So that's going to get us at least 2 more years of this. It's going to draw out for at least 2 more years. The only option that they have is to continue to be buying the Treasuries, to continue to buy the mortgage-backed securities to keep mortgage interest rates low. Honestly, if mortgage interest rates were to go from like 4.5% to 5.5%, Louis, we'd see a drastic change in numbers. We'd see a drastic change in the amount of people that are out there buying. Now,
there's already no one buying.
There's already no one buying, and I'll jump into the report of how many cash transactions took place in some of the major metropolitan areas here in a second. But yeah, I think it's hysterical how the Fed members are out there saying, yeah, the Fed fund rate after we stop, we get rid of QE, the federal fund rate hikes will start right behind that. Of course, you have to say that. You have to give the appearance of what you think that you should be doing, but it's not going to be the reality. The reality is that everybody on Wall Street, hedge fund CEOs, they're all basically they know the pattern of the Fed, and they know that they're stuck. They know that there's nowhere for them to go, so they can talk all they want. And Yellen was actually changed course on us a little bit when she originally took her post, Louis, because she came right out and started continuing the taper. Right, she didn't kind of just hold on, let me see where things are going with the employment situation, and then let's make a decision. She wanted to, keep on where Bernanke left off, and that's going to say, okay, well, things must be getting better in order for them to start pulling back the taper. But
even though they weren't, they used the weather as cover.
Right, and they had the weather as cover, and now we've got the Russian-Ukraine situation, which kind of diverts a lot of attention. We've got...
That's going to come back, Ryan. Remember, we talked about that. We thought that was off the table because the United States didn't do anything. But these sanctions will involve a tit-for-tat between Russia and the United States. They're already blocking certain payments that Russians are making. Russians are making moves to deal with Iran, not using the dollar. And if this blows up, then the Fed has cover also to start printing money.
Yeah, and you know what? The Fed can actually, they can, or the Fed and the United States, they can always create some sort of diversion, right? If things really get bad, that's all they do is they just divert attention away from the problem and find a bigger problem, right? So this has been going on for years. Nothing much is going to change. I think it's I actually get a lot of comedic relief by reading these articles when they start to really push things, because now that we're having such a late start to the spring, it's like I kind of forgot all this took place, because normally these articles would start coming out in February. You know what I mean? Now we're almost into April, so it's almost like my brain has been trained to start reading this stuff a couple months prior. But yeah, I don't think much is going to change. There was an interesting. I was reading an article, and I believe it was PNC did a small business survey. Now, I obviously have a major problem with the way a lot of these surveys are done because I don't know who they're actually polling. I don't know how the people that they survey are chosen. But they said that 30-some% of the small businesses that were surveyed said that they plan on raising people's wages and or their salaries and or hourly wages. And I just find that really hard to believe. Anybody when they're surveyed can say, I plan on doing this.
You want to make yourself look good, too.
Exactly. It makes it look like your business is probably growing. Nobody wants to come out and say my business is struggling, right?
But we know, Ryan, that the actual statistics show over the last 5 years, wage rates have been flat and basically negative if you counter in inflation. So even if an employer were to raise someone's wages after 5 years and after cutting 10, 15, 20% of their staff, it's not that big of a deal.
Right. Oh, no, not at all. And, the funny thing is that on top of...
You got to pay people after, they're doing double work because their colleague got fired and they haven't had a raise in 5 years.
Yeah, but that small business is more likely to give an existing employee more hours if they have more work than to hire a new employee, right?
Oh, absolutely.
They're not going to go out and hire another employee. I mean, with Obamacare, with everything else that's out there, with rising costs that these businesses have, they're trying to do anything that they possibly can to put themselves in a better financial position, which is not going to be a reason that they're going to want to go out there and just hire a lot more employees or really rise, make their wages, give them a cost of living increase or whatever it may be of another 2 to 3%. It's not going to happen.
And corporate tax rates are the highest in the world in the United States.
Right. I mean, it's not. This is not the most conducive environment for small business. And I've talked about this for some time now. The whole.
What about the loans, Ryan? Right? They don't get loans.
They're not getting.
You would think with all this money out there from QE, at least they'd be putting it into capital formation for small businesses. That's not what they're doing with it.
And I was a big advocate if the Fed actually did care. You know what? If Yellen actually did care and wanted to potentially help small business, she could actually do something, Louis. She could say that the money that's getting lent out to these banks at nothing, right, at zero,
right.
But there's a portion of those proceeds that have to be that they could demand. The Federal Reserve could actually demand that a portion of those get lent out to small business, or they're not going to be borrowing at 0%. They could do that.
And they probably will, Ryan, there it is. That's probably what they might do. That's how they'll get their inflation, because they'll flood the market, the money that's been sitting on the balance sheets into the economy to be able to get their inflation that way, not from printing, but from releasing the money that they've given to the banks to increase the velocity of money. But don't expect any economic revival from that. You'll get the inflation because the way the money will be handed out, you can be assured that there'll be all types of restrictions, all types of making sure it goes to the right type of businesses and not the ones that they want to get the money, and not the ones that are most capable of producing jobs. Right. And so you'll get inflation, and you'll get no new jobs, and then the Fed will say, see, this program worked, we have to expand it. So next month, we're going to take a portion of the money that the banks have that we put into them, and earmark those for small businesses. Then it'll be minority businesses. Then it'll be green businesses. Something like that, perhaps.
Yeah, and have you ever talked to anybody, Louis, that's ever applied for a small business loan? They say it's pure pain to go through that process, right? Like it's not a simple process. You have to be not only have to submit your application, you have to be lucky enough for them to choose you, right? It's not.
Or you have to know somebody who will choose you.
Or know somebody on the inside that would potentially get you put you to the front of the stack. But they're few and far between. I mean, we need small business. I mean, back when things were really going well, small businesses were thriving. Now, in relation to housing, a lot of those small businesses were businesses that were involved around housing. I mean, landscaping and home improvement and all the other things. Everything
Electricians,
else,
right? Exactly.
They all benefit in a market like this. And right now in major metropolitan areas, I'm sure if you look and you see the sales of things at Home Depot and Lowe's and things like that, I'm sure they're up right now because equity positions in most of these houses in these major metropolitan areas are up. So what people do, they go and borrow money out of their house and they go and do things. That's what happens. But it's not because they're making more money.
Nope.
You know what I mean? It's not because they went into their savings account and took out some money to go buy their John Deere tractor.
Well, they might have done that too. Not their savings account. They might have put it on the credit card.
Correct.
Or their home equity. Either way, it's debt-based.
And you know, it's a funny thing, consumer confidence, when everything seems to be going well, or the media makes it seem like everything's going well. When people feel good and they feel like they're turning the corner, they've got equity in their house, it's a lot easier for them to reach into their pocketbook or wallet and grab that credit card to make a large purchase. Right? It just is. Naturally it is to be able to do that, versus if you felt like your job was on the line and you felt like your home value was declining, you would probably be scared to do all those things, right? And
absolutely.
This is part of the master, the Wizard of Oz, the Federal Reserve and the media, as to controlling essentially people's mindsets. That's exactly what's taking place here. It's nothing new. Article that was, let's see here, it was in CNN Money. I believe it was CNN Money that ran this one where the headline was "Home Buyers Getting Priced Out in Cities Across the United States," and it was showing the hottest housing markets across the United States year over year. Las Vegas had a 24.9% increase in prices, which is huge. But if you remember, Las Vegas is one of the hardest hit areas when housing went down, so I would expect that to come back relatively strong. San Francisco was 23.1%, San Diego 19.4%, Los Angeles 18.9%, Atlanta 16.8%. Atlanta was another city that got hit really, really hard, and I find it interesting that 3 of the 5 are all in California. So we have rising home prices, and the article goes into great detail to say that it's very frustrating for all these new prospective home buyers that they're not able to buy a home. Rising home prices, tight inventory, and there's so much competition out there that they can't even get into the market. And they wanted to get in the market 12 months ago, but they couldn't because there was multiple contracts offers. They're still out there looking a year later, and now home prices have increased 20%. Interest rates have risen up 0.5 to 1% higher than where they were, and it's leading to frustration amongst everybody. And they go on into the article, and they kind of, at one point, they show, well, just in nationwide, in February, 35% of all the offers in the United States were cash in February. So that's more than a third. More than a third of the transactions were cash. Now, in a normal market, Lewis, would we see 35% of all the offers being cash?
Absolutely not.
And that's nearly a 30% increase from a year earlier. I mean, that is extreme. And then that's about to stop. Exactly. I mean,
so you can take those houses that are being sold to investors out of the demand for homes.
Well, and Lewis, what's one of the biggest components to cash offers that everybody forgets? There's not an appraisal involved on a cash offer, right? So
no, because the only person who needs to worry about whether they're making the right decision on the value is the guy throwing the cash at it.
Exactly. And guess what happens when, if on your street, your house, you put it up on the market for $600,000, but the comps were only bearing $550, but you get a cash offer at $600,000. When that transaction closes and the realtor, the listing agent, lists the closed price, they put $600,000, they put it was a cash transaction, you now have a closed comp at $600,000 that you probably would not have got if it was 10% cash transactions in a market, right?
The appraisal wouldn't have come through.
So look what we have, and everybody wants to know how we have these rising home prices, because when you have cash that's involved, it changes the dynamic of the market. But the reality is that most first-time home buyers don't have $300,000, $400,000, $500,000, $700,000 laying around to buy a house.
But it also means, Ryan, that the people who are now borrowing money against their home equity, which has risen, are borrowing against the mirage because their house really isn't worth that much.
Right.
Because now their comps show that, that house went for $600,000. Well, mine must be worth $600,000. Now they go out and they borrow $50,000 because they're now $50,000 ahead, when really, in reality, in a true market, they wouldn't be $50,000 ahead. They'd be at $550,000. And when the investors leave the market and homes start to sell without the investor support, that house will sell for $550,000 and they'll be underwater again.
Right, exactly. Yeah, and in a lot of these major metropolitan areas, so they go in and they say, in the Bay Area, cash is coming from the deep-pocketed tech workers. In New York, the Wall Street workers, they've got these big bonus checks. Obviously, we know what's going on with the stock market right now. Foreign buyers are coming in looking to park their assets and all paying with cash. And even they go in even greater detail in Florida. The South Americans have been buying up a lot of real estate. In February, in Miami, 71% of the sales in the Miami area were all cash deals. 71%. I mean, these are astounding numbers. Like,
so how if you think about it, it's supposedly a recovery, and the Fed is supposedly taking credit for the recovery, which you would think means that they're making mortgage interest rates low, so the average guy and gal can go out and buy a house. Well, that's not what's happening. They're putting money in the pockets of investors so they can go and bid home prices up.
Well, I think I
to the detriment of the first-time home buyer who is totally priced out of the market, not just on price, but because of their economic situation, which hasn't improved in the last 5 years because of this low interest rate policy and quantitative easing.
Yeah, I'd actually like to be on a panel that asks the Fed questions. I'd like to say, well, Mrs. Chairwoman, how is it that there's 71% of all sales in a major metropolitan city, they're cash? Do you think that's probably a good sign?
Is that a success? Is that a sign of recovery? Well, they have said, Ryan, Bernanke and Yellen both. Yellen even more explicit. Bernanke says when he was asked about, what do you think about your low interest rate policy hurting savers and they don't get their interest? He says, well, everyone benefits because, a lot of people have houses, so they go up, so that's good for them. Yellen went on to say, after she was appointed, before she took the reins as chair, she said, everyone says, or some people say, that quantitative easing is just for the rich. That's not true. And then she went on to cite basically a wealth effect. The stock market goes up and housing prices go up, as if just the fact of that means that it's good for everyone. When you're pointing out, Ryan, it's good for people who are buying and flipping houses, and it's good for people who have stock market portfolios, but it's not good for people who want to go out and buy a house, for the vast majority of people who either don't qualify for credit or don't have a job or don't have a full-time job and don't have the wage increase to pay these higher prices that are caused by her, Janet Yellen, and Ben Bernanke's zero interest rate policies and quantitative easing.
Yeah, I mean,
they know that, and they gloss over that.
You know what? I will give them this, Louis. If there is a recovery, it's just a recovery for the rich to get
absolutely
rich, right? There's no gain for the average American. There's not. Because, the likelihood of somebody being able to get a loan, well, let's just put it this way. Let's just say that somebody's lucky enough to get a house under contract, okay? Right. They're lucky enough to get the house under contract because they maybe didn't get bid out by another cash offer. They get it under contract, but then they maybe probably have a 50-50 shot as to whether their loan's going to go through.
Right.
Right? So it's not just enough to even get the property under contract. Then you got to worry about, is my loan going to go through? Are there going to be any hiccups? Is there going to be an appraisal issue? Am I going to have home inspection items that make me not want to buy this house anymore? Oh, well, now I found out I had a $2,000 large deposit on my bank statement, and now I'm getting declined for a loan.
Now you're dead.
It's not just as simple as,
and right, it's not just as simple as raising home affordability. That's a bad thing that's happening to people because of this environment with low interest rates and quantitative easing. As you mentioned, you're creating a wealth disparity. The rich are getting richer and the poor are getting poorer. But also for people in their homes, Ryan, that aren't taking out equity loans, their property taxes rise now because they base it off the value of the house. A lot of people are stuck in their homes because, they're not sure whether they can move, whether they can stay, so they can't go to a place where they get a job. And it's bad for our industry, isn't it, Ryan? Because higher prices mean lower volumes, which means less work. Yep. For real estate professionals, mortgage people, and so on. And then it all comes crashing down.
Right. I mean, it's very alarming just in general, Lewis, when you see a 24% increase in prices in any city across the country in 1 year. Right.
Without a corresponding, even remotely corresponding indicator that the economy is doing as well.
Do you think that jobs are up in Las Vegas?
At best, they're flat, probably. I don't know the Las Vegas market, but we know nationally the economy is not roaring.
No, but I'm just saying I feel like of the 24.9% increase in prices, it's probably not a reflection of the job situation or being more plentiful in Las Vegas. It could be that there's probably just more investors that are willing to gobble up those properties at lower price points. Which
basically, you're right. It's a distortion of the market 10 years ago, and it continues a distortion of the market. They bid them way up, they crashed, now they're going back up, only because of the way the availability of credit is for rich people, investors.
Yeah, and it's almost interesting too, because it's like the same people that gambled back when we were in 04, 05, and 06, when everybody was buying up all these properties and then they lost them. A lot of those investors are right back at it, buying up the same properties that some of them let go.
Oh, sure. They're degenerate gamblers. They're like stock market junkies or Bitcoiners, people who they see momentum, they think they jump on it, and they're not smart enough to jump off it.
And you brought up a good point, too, about the whole quantitative easing thing in savers. So, I talk with people all the time, and some of the older clients that I have that are retired, they are very, very, very worried right now, Lewis. Very worried, because we've been for a very an extended period of time now with interest rates that are really low. So the savings rates, the CD rates, everything that they were banking on before, where they were at least getting maybe like 2 or 3%, and
nothing.
They're getting nothing. But and this is kind of the tell sign. My grandmother is probably one of the most conservative women I've ever met. She a couple of weeks ago brought me like a piece of paper, and I was like, what is that? And I looked at it, and it was one of her neighbors' basically stock account, okay, who is retired also, who is also retired, and said that she just couldn't live off of what she was living, and my grandmother asked me, she's like, well, do you think this is okay? She said that her stock guy made her like $25,000 last year, and like literally like 15-20%. And for my grandmother to come asking me that is basically a sign that it's just like they feel like they're being almost pressured into putting their money somewhere that they really don't want to, but they feel that they have to.
Well, they have to, or they have to go work in a grocery store.
Right. And that is a very bad scenario, because what happens when all these people rush to dump their money into the market, and we know when it comes tumbling down, who's ultimately going to benefit? The stock, the brokers aren't going to care whether you win or lose money. They make their fees regardless.
Oh, absolutely.
You know what I mean? And this is unfortunate, because I can see all this, and you and I talk. When is it gonna end? When is it gonna hit the fan? Well, hopefully for some of these people's sake, including my grandmother, not anytime soon. But we've always posed the question, what's the timeline? And nobody really knows. And I have always said, not on Obama's time, but it would seem like it's got to happen probably in the next 3 years. It would seem.
Unless, that's the design, Ryan, but unless things come to a head and the market, whether it's the Chinese, Russians, do not like the situation with the dollar,
right,
and they make moves to stop buying treasuries, dump treasuries, stop using the dollar. If that happens, there's not much the Fed can do. They can print money, they can lower rates, they can go to negative rates, they can do bail-ins, bailouts. That's the only thing that will stop this, because otherwise the Fed appears to be 100% in control of the game.
Yep.
They managed to keep rates low. They managed to keep funneling money to the banks, funneling money to their buddies, and they managed to keep everyone thinking everything's getting better. They've done the right thing. They saved us from financial calamity in 2008. We've got a growing economy. GDP is going up, even though the GDP has gone up less than the amount of money that they've printed. No matter. You see, if it wasn't for us, the Fed, we'd all be living in poverty. And look how well things are going. And isn't your home value headed higher?
Right.
And by the way, we understand, the job situation is good. Well, we're going to do something about that too. That's Janet Yellen's latest.
Right. Yeah.
They've got everybody convinced that they are the masters in control of the economy and that they know better. And basically, because of that power they have, they're able to dole out money to wherever they want, to their friends.
You would think, Lewis, over the last 5 years that these so-called magicians would have figured out that they cannot manipulate the markets and to get to achieving something, right? It's not going to work.
Janet Yellen has never had a job, so she doesn't know what works and what doesn't work. She knows if there's a white paper that agrees with her, or she pushes some button or increases something by X percent, something should happen. When it doesn't, she gets perplexed.
Right.
Well, that's because the world doesn't react to the Fed. The Fed should be reacting to the market signals. Instead, they're trying to send market signals.
Yep.
They're trying to be the market. You say this all the time. There is no market. It's just, what is the Fed doing? And unfortunately, there's some truth to that. Because they managed to officiously intermeddle so much in the market that, in effect, they are mostly the market.
No, they are.
They've removed price discovery. They set interest rates. The market doesn't set interest rates. They try to force people into housing, force people into the stock market.
Yeah, well, this morning on NBC or Squawk Box, one of the hosts was arguing, so is the Fed responsible for price fixing the bond market? They're responsible for everything. What aren't they responsible for? I get so sick of the talking heads not understanding this. You do this for a living. You're a host of these shows. You see day in and day out what's taking place for how many years now, and you can't see that you and your buddies, well, I mean, some of the hosts can't even really invest money in the markets, but they obviously know that the stock market is propped up because of the Fed. We have bond prices where they are because of the Fed, right? Everything that's happening is because of the Fed.
Absolutely.
If the Fed was not involved, if they weren't backstopping everything, do you think the stock market would be where it's at right now? There's no way.
Well, there isn't. Well, maybe it would be if they let everything collapse in 2008 and naturally new industries came about and the stock market rebounded in an organic fashion, perhaps, but no way under the current circumstances. It's got 5 years worth of money pumping into it and stimulus. That's the only reason it is where it is. And they actually think they can print $4 trillion, stop printing, and then say, okay, everything's going to be fine, as if there's not going to be consequences to that.
Right. Well, and you know what it's been really interesting, too, because I was reading on one of these blogs that some of the things coming up, and, a lot of these banks don't actually have the cash on hand. Like, there's been a lot of people and we talked about this once before, a lot of people going into banks and not being able to pull out large sums of money without giving their bank notice.
It's like in It's a Wonderful Life. It's in Jackie's house. It's in Mary's house.
But, this all kind of starts at the top with the Fed because everything is kind of digitized, right? The money that's lent out just kind of it passes through zeros on computer screens. It's not
actually, Ryan, the cash itself, they say 60% of the bills are outside of the United States, the physical cash.
Right, so they're not even here.
Right.
Right. So when somebody goes into their bank and asks for, hey, I want my $1 million, they're going to look at you sideways. Well, you didn't call us, and you're going to have to give us
million. You try to go and get, I don't know. There's stories of people trying to get 10,000.
Oh, not just that, but then you want $1 million? What do you want $1 million for? Then the suspicious SAR report starts.
Not your business.
What do you want to do with $1 million? Well, guess what Chase has now done? I've read this. This was on Facebook, and I was watching about 700, 800 posts about this. Chase now, if let's say that you wanted to pay rent to me, Lewis, and you wanted to go deposit cash directly into my account, and I gave you my account number, they
want ID.
Yeah, they want ID. What do you want ID for? What is it? Because now it's money laundering. Well, guess what happens now? We've created this whole vicious cycle. There's going to be more regulations with the banks because they're not going to want this to be, all these different cash businesses taking place. They're going to want more and more regulation on things. I mean, things are getting more and more out of control every day.
What if you don't have a bank account and a checking account? Oh, I guess you have to show ID to put cash into to pay your rent.
Yeah. But what does it matter? Why should you have to identify yourself as paying somebody cash, depositing it right into their account?
See, this is the reason why the people go for these digital currencies that are absolutely worthless, because they value at least some level of privacy and some level of saying, look, why do we need a bank intermediary who is so onerous in terms of what they make you tell them and then the fees? They want to get away from the banking system so much that they'll put their faith in these thin air digital currencies. It's understandable that there's a reaction against the bank. It's just that digital currencies backed by nothing aren't any better other than there's no bank involved, but then there's nothing involved in the currency either. It's just a bunch of numbers that they invented and want to assign value to.
Well, yeah.
But it wouldn't exist if the banking system was a normal, competitive market where people would go to a bank, and if this bank didn't treat them well, they'd go to another one, and eventually you'd have high-quality services in the bank. There'd be no bailouts, and there'd be a really decent market where banks would be competing for your money on service and price. Because they're not, people hate banks. There's really no reason to hate a bank if a bank, just like any other business, provides a good product and service. The problem is they don't. They're mandatory. You have to have a bank account. They have to know everything about you.
Right.
And any other business, you wouldn't put up with that. If you want to go buy a hot dog and the guy says, let me see some ID. What?
Right.
You wouldn't buy a hot dog from that guy.
Right.
And if he was the only hot dog salesperson and he sold lousy hot dogs, that's what the banking system is.
Well, not to mention the fact, Louis, that they act like it's their money, not yours.
Absolutely.
You know? I mean, I've never seen anything like it when you go in there and you get a million questions and you're like, can I talk to your manager real quick? Because when I opened this account, I put in X amount of dollars. And now
you didn't put in. You lent them money.
Right.
They're the borrower. They should be looking up to you because without you, they wouldn't exist. But that's not true. They've created a situation where you need them. The way they've got it set up is they force you to lend them money.
Right.
So they can charge you points on the money you lend them when you're supposed to be charging them points, which is the interest they're supposed to be paying us.
And you know, and the way the system's set up now, too, with, you know, the automatic bill pay, and I mean, it would be literally a nightmare for you to not use a bank, because what you would actually have to do,
absolutely.
You'd have to go and cash your check. You'd have to take the cash, and every time you wanted to pay a bill, you'd probably have to get a money order. So you'd have to go and get the money order, and you'd have to send it to each and every one of your creditors. You know what I mean? I mean, that would be literally a nightmare. So people think that, okay, they're going to save time and energy and effort. They'll just use a bank just because it's the path of least resistance. And this is the system they've created, but it's really a system that they've created to maintain control. So this is just another control thing, control people.
And that's why they did what they did to Bitcoin with the IRS ruling. The IRS ruling figured, so Bitcoin people are trading without the central bank. They can make these transactions, and they don't need us. Well, we're not going to recognize it as a currency. The IRS said, we're going to call it property. And because it's property, each time you use it constitutes a sale of property. So when you buy something on Overstock, now you've incurred a gain or a loss. So you have to keep track of that. Well, if you're using it as a currency because you think it's convenient, they just made it inconvenient for you to use it, thereby making it not convenient to use. And if it's property and the only advantage to having it is that you can use it as a convenience, they've undermined the value of the property.
Yep.
So that's intentional because they want to make sure that you use a bank and that there isn't something better unless that, quote, something better comes from them. So they made it inconvenient for the Bitcoin user and very convenient for the IRS because now they not only they've killed two birds with one stone, they've decimated the ability of people to use Bitcoin as a currency. They've lowered the value of the property, but they're going to extract tax for all the gains that have been made up until now on the use of Bitcoin.
Yep.
There's really no end to the tricks they can come up with. It's not just the banks, it's the Fed, it's the IRS, it's the Treasury Department, it's the Department of Justice, it's the SEC, the CFTC. All of them can act individually or in conjunction to squash any threat to the banking system.
Yeah, because there can't be a threat to the banking system. You know what I mean? That they won't allow for that to happen.
That's what gold is a threat. silver is a threat, whatever's a threat, they have mechanisms to get in the way, to muck up the works, to make sure that that threat is neutralized.
Correct.
They don't have to absolutely ban anything. And what's funny is you read people thinking, oh, this is good for Bitcoin. No, it's not. Because if it was taxed another way, it might have been taxed higher. They don't realize that they've actually undercut the whole value. And it'll become apparent as you go along, as people have to start paying bills on or getting tax assessments for prior years once they find out that you're a user of this currency. And they'll find out. They mine the blockchain. They can ask companies that deal in Bitcoin for the names of the customers. They can then match them up against their tax returns. They say, well, you don't report any Bitcoin gains. It looks like you've used Bitcoin, so what's going on here?
Yeah,
they can harass you any number of ways.
It's going to do? It'll trigger an automatic audit. You know what I mean?
Absolutely.
It'll be an automatic audit. They'll take all the names of all the people that use Bitcoin. They won't see it reported on a tax return. Oh, guess what? You're going to get audited this year. And then you're going to end up owing a lot more money.
Now, those people may say, well, I'm an anarchist. I don't care. I'm not going to pay. Okay, fine. But when people hear about this, the average Tom, Dick, and Harry, the incentive to go out and say, oh, I'm going to go get some Bitcoin because it's convenient now, when you realize by doing so, you got a big X on your back from the IRS because they're going to want to know what you used it for. And besides, as it drops, why would you want to hold on to the Bitcoin if it's dropping? If you want it for convenience, you don't need to hold it. Holding it can only incur you a gain or a loss that you have to report. That's speculation. And your Subway sandwich shop still takes cash and credit cards, so you don't need to go out and get yourself some Bitcoin to use at your Subway shop.
Yeah.
So now they've effectively, I don't see how it has any future because the government has effectively undermined it without even banning it.
Yeah, and that's exactly what their intentions were, to not ban it, because they didn't want to be seen as Big Brother there shutting down something, right?
No, they don't want to cause any type of revolt or any type, not revolt, but people being openly against them.
Well, and it's a lot more difficult. I mean, you laid it out very nicely there as to what's actually happening with it, but most people wouldn't be able to understand that, right? They're going to
it gradually happens. It's like the boiled frog.
Right.
They don't realize that this is a bad thing until it's over.
Well, yeah, they're going to be out there
the threat has been neutralized.
They're buying stuff with Bitcoin and don't realize that now all of a sudden they have to report it, right? And then
or they're buying it as a speculation and thinking it's going to continue to go up when they don't realize that fewer people are going to be attracted to using Bitcoin and buying Bitcoin if it's not going to go up in value anymore because it's going to be deemed inconvenient to use because people aren't going to go out and get themselves some Bitcoin.
Yep.
And then merchants aren't going to want to adopt it. It's just like the FATCA rules for foreign banks. They don't want to deal with Americans because they don't have to report all that stuff. Well, a merchant's not going to have to set up a separate account to handle their Bitcoin transactions.
Right. Is it any wonder, Louis, that all of these American businesses are wanting to move into other countries like Chile, South American countries, and all these other countries are welcoming?
Well, they have, and they keep their cash there. That's another problem. If they would take the tax away from people, the United States bringing that money back, you bring the troops home and the money home, you might actually have something going. You bring your money home and your young men home and young women home. That might help the economy.
I would think that it would. But anytime that we have any sort of common sense solution, they'll never do that, right?
No, because they don't make any money off of that.
Right.
If you bring the troops home, the whole military-industrial complex goes down. If you let the money come back without tax, then they don't collect their tax.
Yeah, but I mean,
you may create jobs, but well, the one thing though is if they do create jobs, there actually is a greater incentive for tax them because then they can tax the money that people make.
Right. I mean, when somebody's over here and they're going to be, losing pretty much half their money just to taxes alone, it's not a very good thought to think of even starting a business here now when you know of all the costs. I mean, the cost alone between the insurance and just basic wages to pay to people and everything else that they have, you don't really see many small businesses thriving right now or even wanting to grow, right?
The only kind of business that makes sense to invest the money and time into is one that isn't going to make money. And that would be an internet type stock or a social media where you're going to make far in excess of the money you put in. But if you put in money into a business where you figure out your margin and you figure you might make $100,000 net profit your first year, that's a very difficult slog compared to you set up one of these social media companies and you can sell it to Google or you can sell it to Facebook and make $300 million, $800 million, or like this Oculus company, $2 billion.
Yep.
That's the smart investment. Well, that's actually quite dumb because that doesn't lead to really any creation of full-time jobs. And eventually, when the market crashes, those types of companies go straight down because they have no earnings.
Yep. Yeah.
So they're encouraging even the entrepreneur not to run a business the right way. They're encouraging him to get involved in speculative type businesses.
Well, not to mention most of those businesses, those tech businesses, like Google, they're out there buying. Well, I think they bought that WhatsApp or whatever for some absurd amount of money. I mean, they bought them up because of the amount of users that they had. You know what I mean? They're not buying them because they necessarily like their technology or all that stuff. They're buying because they're users, and then they can say they didn't want another company to come along and potentially steal some of their users, right? So they can just take more.
Ryan, you and I could have the most popular restaurant in the D.C. metro area. We get VC venture capital funding, and we have free food. And it's not just free food cafeteria style. We offer the finest food, and we put all the restaurants out of business. And then the more diners we have, we expand, and we get even more diners. Then we get people to have a subscription for free food. Next thing you know, we are the largest food company in the D.C. metro area, and we're expanding into Virginia, and investors are cheering us on because we're giving away more and more food, but yet we have even more customers than anyone else. And we have the best food.
Right. It's not about what you produce and how much money you make from it anymore. It doesn't matter.
It's how many people you can get to use your product.
Yeah. It really is crazy. I mean, with technology, how things have changed.
Well, it's what they've done to Wall Street, though. Remember, they rewarded that in the .com area, and then eventually that all came crashing down. They realized eyeballs and reach and all that were useless metrics from a financial standpoint. Well, we're back to that now.
Yep. And there's nothing that I mean, short of the Federal Reserve backstopping everything, that would have the stock market plummeting 50%.
The stock market wouldn't reward that type of speculative venture in a normal market.
Correct.
They'd be looking at dividends. Who pays a dividend? They'd be looking at earnings, dividends, things like that.
But they will reward it when they know that the Fed's there to lend the cheap money and there to bail out anything that has that starts to fall on its face.
Well, look at Tesla. Tesla has a market cap probably bigger than all the auto manufacturers.
Yep.
Because it's speculative.
Yeah, it really is amazing. I want to jump in. We're almost at the end of the show here. I wanted to give a quick credit tip of the week. We didn't get one in last week, so I'll get one in this week. So many people are wondering, how long do credit challenges take? So anytime that you're going to challenge or dispute something on your credit report. So as a general rule, 30 days if you file a dispute. And this was brought to you by the Credit Pros. If you need to contact them, I can give you their phone number, which is 800-411-3050. But 30 days if you file a dispute with the credit bureaus. They have exactly 30 days to complete their investigation. Now, if you file a dispute with the credit bureaus and then they provided supplemental information, you'll have provided them an additional 15 days. So then they have 45 days. If you file a dispute with the credit bureaus and the dispute happens to fall under the credit bureau's policies regarding non-investigation changes, then your credit report can be updated and corrected within a few days. Now, if you never notify the credit bureaus that your credit report contains errors, then it's likely that it's never going to get corrected, right? Which is the case in many people's case. This is what happens almost all the time.
Right.
The Fair Credit Reporting Act allows for credit bureaus to ignore your request for an investigation if they deem it to be frivolous. So if you send a letter to the bureau saying, I dispute everything on my credit report, it's unlikely that you're going to get a response. It's probably going to be thrown in the trash. And if you dispute the same item over and over, the credit bureaus can eventually deem that to be frivolous unless you provide new information regarding why you believe it to be incorrect. So what do they recommend? What do the credit bureaus recommend? What do I recommend? I recommend that, the fastest way of removing the derogatory item is to negotiate directly with the data furnisher. So whomever is owed the money, the collection agency, the original creditor, whoever it may be. So working with the creditor pros, they will negotiate directly with your creditor or collection agency directly. Let them handle. They have attorneys on staff that can handle this stuff. And then oftentimes they are able to convince the creditor to completely remove that damaging item. Now, oftentimes it's in exchange for paying them money, but then they'll provide a letter of deletion, which then they can provide directly to, if you're trying to apply for a mortgage, to the lender, and then the lender can get that rapid rescored in literally a few days. So you can see that there's ways to go about things in a more swift manner, which typically does involve getting some professionals involved. But instead of necessarily sending in something to the credit bureaus, waiting 30 to 45 days, you can potentially deal with the creditor directly, potentially get them to give you a letter for deletion, and have an item permanently removed from your credit report. That's a much better way to go about it than probably sending in things, waiting for 30, 45 days for them to come back to say, we've called the creditor, and the creditor says that this is accurate, right? Well, then you can dispute it again and again and again, and they have to provide information documenting why it's accurate. But it's easier to just hire the credit pros or another legit credit company and have them, take care of this for you. So just a little tidbit of information there, but the average is about 30 to 45 days. That's all we got for today. Louis, will you let our listeners know where they can check out your blog?
Sure.
They can read your weekly posts?
Smallgold.com, SMAULGLD, smallgold.com. You can read a post or two each week on the economy, Federal Reserve, real estate, gold, and silver.
Awesome. I appreciate it, Louis. Thanks.
Thank you, Ryan.
As always, guys, if you want to check out our podcast, like I said, go to iTunes, search Real Estate 360, or streams on the website at realestate360live.com. Until next time, see you then.